Hey everyone, my name is Anthony Brister, and we're on the Wealth Planning Podcast with Brister Law. Today we're going to be talking about, do I need an S-corp, and when should I make that S-corp election? This topic is really important because business structure can make a big impact on your tax savings and also on how you're protecting your assets. So, first, I always recommend, if you're starting a business, you probably should be considering forming an LLC. An LLC doesn't really give you any type of tax savings per se. So, what you would be able to deduct without an LLC, you'll be able to deduct in an LLC and vice versa. The LLC doesn't give you any tax benefits. What the LLC is there for is to give you asset protection, meaning you're going to separate the business from your personal assets. And if something happens in the business, your business assets aren't going to put your personal assets at risk if you're following all the formalities. LLCs are a little bit more flexible in the management. Now, they also have less requirements compared to corporations, but that doesn't mean that you should be lax, because by having those formalities, you're actually making your asset protection case a lot stronger. Tax wise, though, LLCs aren't very tax efficient for active income, meaning income coming from your business. That is because you're subject to self-employment tax, which is Social Security, Medicaid tax, which is around 15.3% on your first $165,000 of income. So on $100,000 of income, if you're getting paid into an LLC, that shows up on your Schedule C on your 1040. On that $100,000 of income, you're paying $15,300 in self-employment tax. That's Social Security, Medicaid tax. Now, if you're an employee, typically your employer covers half of that and you pay half of it. So you're paying 7.65, your employer's paying 7.65. But when you're self-employed, you're responsible for that whole amount when you have a Schedule C business. So let's get to today's topic, really, and it's, when do I need an S corporation? And when do I make that switch from just an LLC to an S corp? I recommend taking a look at your net income. So that is your income after all of your expenses. And when you're around 50,000 in net income, I think it makes sense to make that S corp election. And again, the primary benefit of making the S corp election is the ability to reduce self-employment tax, so that 15.3%. You reduce your self-employment tax by owner distributions. So there's two ways that you pay yourself out of an S corp. The first way is through a salary, and then the second way is through the owner distributions. So on the salary portion, you are required to pay a salary. That salary is subject to the self-employment tax, and you're required to pay yourself what's called a reasonable salary. We'll talk about that here in a minute, but just know, on the reasonable salary requirement, you're paying that self-employment tax, that full 15.3%. Now, on the remaining of the earnings after your salary, you can take what's called a owner's distribution. That portion of your income is not subject to the self-employment tax. So I had a client who was earning $150,000 a year. He just had a Schedule C business, getting paid into an LLC. On that $150,000, he was having to pay the full 15.3% self-employment tax. So he was paying around $22,950 in self-employment tax on that $150,000 net income. So we decided to make an S-corp election for his business, and we decided to put him at around a $50,000 salary and then take $100,000 in owner's distribution. By doing that, we saved him over $15,000 in the self-employment tax, because he was only paying the self-employment tax on that $50,000, and he was avoiding it on that $100,000 of owner's distribution. So that $15,000 is every single year following that if he continues to make that much. So that can really make a huge difference on your tax bill just by making that simple election. However, having an S corp, there is some downsides. So one of them is you have to file a separate tax return. So there is costs associated with that tax return. You do need to be a little bit more formalized than just an LLC. So, you probably want to be having a bookkeeper, having QuickBooks, keeping track of your business. You have to set up payroll, pay quarterly filings, file all the payroll tax returns as well too. So there are some downsides, and that administrative cost does eat into some of those savings. So that's why we say, at 50,000 net income, it probably makes sense. If you're under that amount, you should just do good tax planning and work on trying to increase that income so that paying those administrative costs makes sense once you decide to go ahead and make that election. So let's talk about how do you pay yourself out of the S Corp again. Like I said, the biggest benefit of the S Corp is the ability to split your income into a reasonable salary and an owner's distribution. The owner's distribution is what reduces your self-employment tax liability. So to determine what a reasonable salary is, there's a few ways that you can do this. One way is just to look at your industry standard, look at the roles that you do in your business, and pay yourself according to that industry standard. Typically, I look at it as kind of like a sliding scale. So the less money you earn, the more you're going to be paying yourself in salary as a percentage overall. And as you continue to make more, your salary percentage can be adjusted down. Typically, we're looking at somewhere between 30 to 50% of your distributions. Again, the more you make, the lesser that salary is going to be. And also, the less involved you are and the more you delegate, the less your salary needs to be. So the way you pay yourself on a salary, typically I recommend just using QuickBooks online or some payroll service like Gusto. And you can do monthly, quarterly, or annually payroll distributions. You just set that number up, go through the payroll system. They'll withhold any taxes, and you take that just as if you were an employee. The second part is the owner's distribution. And all that is really is moving the money from the business bank account to your own personal bank account. That's the owner's draw, owner's distribution. That portion right there does not get subjected to the self-employment tax. So again, if we go back to that example where the guy was taking $50,000 salary, he was paying the self-employment tax on that 50 grand, which was around $7,500, $7,600 in taxes. And then that 100,000 he moved from his account to his personal account. That 100,000 he was not having to pay the Social Security, Medicaid, self-employment tax. So he avoided $15,300 on that owner's distribution. Really, that's the biggest benefit. That $15,000 can be life-changing, especially if you compound that year after year after year. and you take that money and put it into investment and get it working for you. Now, there are some cons, like we talked about, of the S-corp, and really the cons are the administrative work. So the bookkeeping, the payroll setup, doing the quarterly tax filings, having an extra tax return and paying that. Also, adjusting your salary as your income increases or decreases. Uh, there's also some limitations on ownership for shareholders. Again, typically, I recommend having your own S corporation. So, really don't need to worry about that too much. But technically, there can only be 100 shareholders in an S corporation. The shareholders could only be U.S. citizens or residents. And also, businesses can't own an S corp generally. So, only individuals typically can own an S corp. Whereas comparing that to an LLC, you can have a variety of different owners. There's no limitations on that. The LLC is going to be a little bit more flexible. But on the flip side, the benefit of having the S corp is saving on that self-employment tax, and being able to use that money, keep it in your own pocket rather than paying it to Uncle Sam. So that's really all I had today on the S corporations. If you have any questions, if you are a business owner and you don't have an S corporation, please reach out, schedule a discovery call, go to our website, www.bristertaxlaw.com, schedule a free discovery call. One of my paralegals will have a meeting with you, see if you're a good fit, and then we'll get started with a comprehensive consult. We'll go over your business structure, your estate plan, and talk about some tax planning and tax efficiencies that you might not be doing today. So just to recap, if you're a business owner, you want to first start off with just an LLC. The LLC isn't there to give you any type of tax protections or tax avoidance. Whatever you would be able to deduct without the LLC, you could deduct in the LLC and vice versa. But the LLC creates a line of protection between your business and your assets. Once you're over around 50,000 net income, which is after expenses, you might start considering the S corporation. The S corporation is a little bit more administrative work. You have to file a separate tax return. You have to do payroll. You have to come up with your reasonable salary. However, you do get to avoid the self-employment tax, which is at 15.3% on your net earnings. Again, thank you for listening. If you like this video, please like, share, depending on which platform you're looking at or watching this on. Please give us a follow or subscribe. And we look forward to keeping you informed and giving you some tax strategies for your business.